Mike and Tom are registered with Stewart Partners Global Advisory LLC.
Common Sense Finance with Mike Wiginton and Tom Farrell of HL Wiginton Capital Management, an independent investment and financial planning firm in downtown Jasper. Mike is a chartered financial analyst charter holder, and Tom is a certified financial planner professional. They are here to discuss and give their thoughts on current financial and economic matters. Now, with Common Sense Finance, here are Mike and Tom. Welcome back to another edition of Common Sense Finance. I'm Tom Farrell. This is Mike Wiginton. And today we're going to be talking about active versus passive investment. Now, we're not talking about a money management style when we're talking about this. We're talking about having an active role in an investment and a passive role in an investment. And Mike, I'll let you talk a little bit about how each of those work.
Yeah, so I guess the first thing that I'd mention is that, when we're talking to folks, if their primary pursuit is growing their wealth, because that's not the only plan or strategy that everybody pursues, but that may seem very kind of commonsensical to folks. But if growing your wealth is your primary focus, then the only option is equity. That's ownership. That's what equity, is a synonym for, is ownership. And so when you decide that, then the next choice is it going to be active? Okay, whether you own a business, you own real estate like duplexes, apartment buildings, rental houses. Not that that's the only sort of active investment, or is it going to be passive, where you don't have to participate? And that would be the stock market, okay?
Right.
So if you own Walmart stock, obviously you don't have to get up and hire anybody, fire anybody, turn the lights on. You're not going to get sued, etc. So that's actually a big decision.
Yeah.
And there's reasons that one might, very obvious reasons that one might pursue one route over the other.
Yeah, and it's easy to calculate your return when you're talking about the stock market, or particular investment you own. You can look back and see how it's performed over time. But what about active investments? Did you see some issues with the way people maybe approach those?
Yeah, the first issue is they don't approach it at all. They don't put any thought into trying to come up with a reasonable expected rate of returns. Let's say you're going to buy a duplex or a rental house. What sort of return should you get from that?
Yeah.
Okay, number one, and number two, then how do you go about forecasting that rate of return? It's and it could be a fairly straightforward thing. You know what you're going to pay for it. You should have a good idea about this type of property you're buying, what sort of rent in that area is going to come from that. You should know what your property tax is going to be, your insurance is going to be. A lot of those, you probably don't know as much about what kind of vacancy factor you're going to have or what kind of maintenance factor you're going to have. You can say in general that the older the property, the more the maintenance factor is going to be, and the newer the property, the less the maintenance factor is going to be, at least for the first number of years. So it's actually something that is reasonably straightforward, and we talk to clients all the time, and help folks with it, because a lot of our clients own real estate, and help them formulate a realistic return expectation.
Right. And we've talked about this before, but if I'm going to own a piece of property, say a rental property, and I'm going to have to deal with maintenance issues and deal with renters and things like that, I'm going to need to get a much better rate of return than I would expect to get in the stock market, because I don't do anything. I'm putting my money in. I invested in the stock market. It makes money while I sleep. I don't have to hire, like you said, hire or fire or get involved. So you should expect, because not only you're putting your time and energy into it, there's a lot of other factors that go into it, to where you should expect, in my opinion, a little bit higher rate of return.
That's 100% correct. That's not an opinion. You can certainly, as far as I know, currently it's still a free country. So you can be happy with a negative return. So you can be happy with losses if that's what you like. There's no law against that, but that's not rational. Okay, so So, you know, the long-term return on the stock market is still close enough, as measured by the S&P 500. Right. Okay, it's still close enough to 10 to call it 10 for let's not split hairs. Okay, so if I'm going to go out and I'm going to take all of that risk and go through all the trouble, time and trouble, and deal with that, man, I better get something. I got to get a premium.
Right.
Then the question becomes, what sort of premium? And I tell people all the time, if your expectation on a passive return is 8 to 10%, that's a pretty dang good number, in my opinion, for doing nothing except putting up with volatility.
Right.
And I don't want to belittle the whole emotional roller coaster with putting up with volatility.
Mm-hmm.
But the thing is, which leads to another thing with active investments, is there's volatility there too. And there's a lot of information out there put out by folks that are in the finance business that ought to know better. And that is a pet peeve, one of my common rants about people that ought to know better. And they say things like, well, you ought to get into real estate because it's not correlated to the stock market, and you have smooth returns. That's just wrong, okay? You take IBM common stock, just to pick something out of the hat, okay? It's bought and sold millions of times every day. I don't know what the volume was the last I checked, but there's well over a million shares traded every day. It's bought and sold 1 million times every day. It's constantly priced throughout the day. How many times have you sold your house in the last week? Yeah. In the last 6 months? In the last year? Okay, you might not be a good example on the house, but think about that. They don't get priced, and you can ask plenty of people in New York City and places like Arizona. I go talk to them, in some of these hot spots for real estate across the country. Talk to any of the folks that were in that market in 08 or 09, and ask them if real estate moves around.
Yeah.
Ask
well,
them.
you don't get a statement on your rental property every month like you do your brokerage account. So.
Yeah, that's right. So the whole idea that the asset prices don't move around, though that it's stable, is just that's a very immature, to be nice about it, thought. That's that's not solid thinking. Real estate, and we're kind of picking on real estate, but that's okay. I mean, what active investment do you want to use? Again, we could use a private business. It's fine, but there's an emotional side to that. Mm-hmm. They get emotionally attached. A lot of times, by the time a client comes in and says, "Hey, I'm thinking about buying such and such," they've already bought it, man. Yeah. I mean, they may have not have closed on it yet.
Yeah, the decision has been made.
But if you say, "Well, what's the rent? You're going to put any rent escalators in that?" Something, I don't know what you're talking about. Well, they've already made emotionally made that decision. And things like, but on the positive side of things here, and I'm a proponent of active investments in real estate. I mean, I like it a bunch. As I say to people, it's been my best and my worst investment. But we're on this inflation kick nowadays, and things like real estate where you can build in rent escalators where rent goes up over time. That's one of the few ways, active investments, one of the few ways that you can actually fight and overcome inflation and make money in a period like that. Right. So lots of reasons for it. One of the things, before I forget, taking a real good assessment of your time and your talent. It's going to take a bunch of time.
Right.
Can you give it? Not that you would like to. Can you give it? You have a day job, okay? And then, is this really in your wheelhouse? Yeah. Are you going to like calling people and tell them, hey, the rent's late?
Right.
You're going to like, even if you pay an outside maintenance crew to take care of things, there's going to be some involvement, and you're going to have to pay, whether you do it and give up your time or you pay someone to do it. Right. It's the same. So, is that going to be in your wheelhouse? Are you going to like it? Because the reality is, when you get involved with this, and it's year 1, year 2, year 3, if it's not in your wheelhouse, if it's not, or something you can develop as a talent, you're probably not going to see it through to the end. So just a few things to figure out in that active versus passive decision. As I say, pick your poison.
Yeah, that gives us a lot to think about whenever you're looking at those type of investment opportunities. Well, with that, we'll see you next time. Thanks.